Hi, this is Jeffrey Kerr at Kerr Financial Group, and today is March 25, 2022. Recently it's been a challenge to put together material for either, video or a newsletter. I think I've started two or three newsletters, but as some things have changed and the tragedies and the events going on in the world, kind of put them aside. But also, the markets continue to go on, and I think more than ever, there's some things that people should be aware of, and it's pretty risky. And so I think people should be consider what could happen and to help manage some risk. So today I'm going to go over I think three things that are real important for the rest of this year and for the intermediate term. And those three things are the growth, economic growth here in the U.S. I think it's going to slow. Secondly, inflation. Inflation, I think, is going to stay sticky high. It's not going to be as high as it was just recently reported, but I think it's going to be a nuisance and just change the landscape from what we've been used to for the past 30 years. And then the third thing is interest rates with the Fed, raising rates last week. Also, the interest rates on the Treasury bonds have been moving up and has had an impact throughout the market. So, number one, let's start with the growth. Um, the fourth quarter GDP for the U.S. is around 7%. The and but the reality is it's not going to stay that high, going forward in 2022. And one of the statistics recently reported was that retail sales for February disappointed. They were up zero point 0.3 of 1%. So let's say about a third of a percent, which was down from 4% increase in January. So month over month, we're looking at those numbers, and they were, the retail sales number disappointed and lower than January. And also, if you take out autos and gasoline, with the spike in gasoline prices, retail sales actually declined almost a 0.5%. So that could be a sign. Hey, it's 1 month. It could be a sign of a trend that the economy, the consumer pulling back, and the economy perhaps slowing. And I think that is not in the current prices of both stocks and bonds, and something to be aware of that if it continues to decline or slow or stagnate, that I think the markets have to adjust and they'll have to adjust lower in terms of the stock market. Secondly, inflation. Inflation was up 7.9% year over year on the February reading, and gasoline was up 38% year over year. So the inflation numbers, I don't think are going to stay at 7.9, but they're not going back below 2% like the Fed thinks they can jawbone it down to. I just don't think it's going to happen. And I think that food prices are going to stay up, gasoline prices are going to stay up, given what's going on in Eastern Europe. And I think that these things are going to flow through the economy and be a significant headwind to fixed income people, lower and middle class, workers, and that's going to take a bite out of consumption, vacations, stuff like that. And I think it's going to be a pretty big problem, to overcome. And again, will help contract those or lower those GDP statistics and readings. So thirdly is in interest rates. The 10-year is gone up. The 2-year has gone up significantly too. The Fed raised the Fed funds rate, which is an overnight rate, very short term, but they raised the 25 basis points last week. And the forecasts and expectations are for a lot more of the Federal Reserve interest rate hikes. Goldman Sachs came out earlier this week and said they're expecting a 50 basis point, one half of 1% hike in both May and June. And then after that, for the next four meetings, 25 more basis points on each of the next four meetings after the June meeting. That is a lot of interest rate hikes. I don't think they'll be able to do that. I think if they try to get partway through that, it's going to be a big obstacle for an over leveraged stock market and bond market. I think also, with the inflation, if it stays, in that 4 to 5% area and interest rates going up, that's a recipe and equation for a really bad both economy and financial markets. So I think that the future is very risky, and we haven't even talked about or factored in some of the geopolitical stuff and the sanctions and what happens. I mean, Russia is the second largest provider of fertilizer. Canada's number one, and they may not sell the fertilizer to the U.S. So for farming, those costs are going to go up. I don't know how fungible or elastic the fertilizer market is. In other words, if Russia sells it to somebody else and then sells it, that can flow to the U.S. or just the U.S. has a shortage of fertilizer. I mean, these things are not clear how they're going to play out, and I don't think they're factored into the market. So I do think that there's a significant risk here. Stocks have been are down for the first, will be down likely for the first quarter. And the Nasdaq and Russell reached their peak in November, and they're down, the mid-teens from those November peaks. The Dow and S&P peaked right at the beginning of January, and they're down from there. So we've got the end of the quarter coming up next Thursday. There is the month end games where the institutions try to make things look better, and that could happen. But I still think that some of these issues are going to be could be a big problem going forward. I'm going to try to get out a newsletter next week and get more into detail, on these three or four issues that we spoke of today. Please get back to me with any questions and feedback and suggestions. Thank you. Goodbye.